Hey everyone, this is Ronak Ahuja. In our previous session, we had discussed the changes brought in by the Finance Act to the TDS provisions. In this session, we'll be discussing the amendments brought in by the Finance Act to the TCS provisions. In case you haven't seen the previous video, please do remember to check out the gallery. Moving ahead, let's get to the TCS provisions quickly. The first subsection is 206C subsection 1. This section requires us to collect TCS on the following goods: alcoholic liquor for human consumption, tendu leaves, timber obtained under forest lease or by any other mode, or any other forest product obtained by forest lease or any other mode. Furthermore, sale of scrap or minerals such as coal, lignite or iron ore are also covered under this subsection. Note, there was no threshold under this subsection. That is, even if a sale of ₹1 is made, TCS would still be required to be collected under this subsection. However, there was an exemption. Wherever a buyer includes a public sector company or a central government or state government office, or the person who is buying it for his personal consumption, then in such a case, TCS will not be collected under this section. The rates of TCS are there under the column tax rates. The Finance Act 2025 has made some revisions to the TCS rates. Timber or any other forest produce obtained under forest lease, excluding the tendu leaves, would be collectible at the rate 2%. This was earlier 2.5%. Further, timber obtained by any other mode other than under a forest lease would be collectible at the rate 2% as well. This also was 2.5% earlier. This means any other forest produce which has not been obtained under forest lease, no TCS will be collectible from 1st of April 2025. This is the new change that has been brought in. Let's move to the next section, which is section 206C subsection 1H. TCS will be collection on the sale of goods by certain sellers wherein the sale of goods made exceed the value of ₹50 lakhs during the financial year. Say for example, if the sale of goods made during the financial year to a particular person exceeds ₹50 lakhs, then in such a case, on the excess amount, TCS would be collectible at that 0.1%. This section has been omitted with effect from 1st of April 2025. Moving ahead, next section would be 206CCA. This section was brought in by the Finance Act to penalize the non-filers of ITR. The TDS deducted or collected as per the last financial year exceeded ₹50,000 and the person whose TDS was deducted or collected failed to file ITR under section 139 subsection 1 for that previous year, then in such a case TCS was collected at twice the specified rates. This section has also been omitted with effect from 1st of April 2025. Moving on, next is section 206C subsection 1G. Wherever any remittances are made under the LFRS scheme or the liberalized remittance scheme or any overseas tour packages purchased from the tour operators, then TCS shall be collectible under this section. Remember, if the remittances made that do not exceed 7 lakhs, no TCS shall be collected here. Furthermore, there is one more exemption. Wherever any TDS is collected on any such sum under any other provisions of the Act, then in such a case, TCS provisions will not apply on these transactions. This means the TDS provisions override this subsection. The tax collection rates here are 1.5%, wherein the remittances are made for educational purposes to institutes specified under section 80E, for educational or medical purposes other than the institute specified in section 80E at the rate 5%. In any other case, 20%, including the two packages. As per the Finance Act 2025, the limits have been increased from 7 lakhs to 10 lakhs. Further, the remittances on which TCS was collectible at the rate 1.5%, no TCS will be collectible on such remittances from the 1st of April 2025. This means remittances for educational purposes to the institute specified under section 80E, no TCS will be collected under this subsection henceforth from 1st of April 2025. So these were some of the changes to the TCS provisions. In addition to these, there were some changes made to the income tax slabs as well. The income tax slabs offered no taxes up to rupees 12 lakhs. Let's quickly discuss those along with the rates that would be applicable for calculation of advance tax for all the other SSCs, including domestic companies, HUFs, partnership firms, and cooperative societies. Let's quickly move to that. The Finance Act 2025 has made changes to the Section 115 BAC. Section 115 BAC offers concessional rate of taxes and is often referred to as new tax regime. This is applicable to an individual, an HUF, an AOP, a body of individuals, or an artificial juridical person. The changes to the income tax slab set forth by the Finance Act 2025 is as follows. Incomes up to rupees 4 lakhs, 0% tax. Incomes ranging from 4 lakhs to 8 lakhs, 5%. Ranging from 8 lakhs to 12 lakhs, 10%. Ranging from 12 to 16, 15%. 16 to 20, 20%. 20 to 24 lakhs, 25%. And above 24 lakhs, 30%. Please note, rebate under Section 87A will also be available under the new tax regime. Please note, the new tax regime is the default tax regime. If the assessee does not opt out of the new tax regime, he shall be automatically chosen for the new tax regime. Further, the new tax regime would be applicable to the individual irrespective of whether it being a resident or a non-resident. The rebate under Section 87A will also be available to the new tax regime. The limit has been increased by the Finance Act 2025 from Rs 25,000 to Rs 60,000. This rebate under Section 87A will not be available to an HUF or a non-resident individual. Although the new tax regime offers concessional rate of taxes, it comes with its own set of disadvantages. Let's have a look at those as well. The exemptions available under Section 10, including leave travel concession, house rent allowance, entertainment allowance, deductions for professional tax, interest on loan from housing property, or deductions under Chapter 6A. These all shall be withdrawn from the new tax regime. Chapter 6A deductions means the payments that we make for life insurance, Mediclaim, all sort of payments will also be disallowed under the new tax regime. Furthermore, losses from the house property will not be allowed to be set off from incomes from the other heads of income. No exemptions or deductions from the salary or allowances or perquisites will be available. The depreciation arising out of the above disallowances will also be not allowed. However, depreciation that is chargeable under Section 32 shall still be available, except for the items that is mentioned above. The standard deduction under Section 16 will also be available in the new tax regime. So these were some of the advantages and the disadvantages of the new tax regime. Now let's quickly try and understand these with the help of a few examples. However, before we move to the examples, let me quickly get back to the part I missed. The rebate under Section 87A would be available to the individual only if the net income of that individual does not exceed Rs 12 lakhs. This has been increased from Rs 7 lakhs to 12 lakhs this year. This has been brought in by the Finance Act 2025 and is one of the amendments. Now, moving ahead. So here are 4 cases with 4 different individuals. All the 4 individuals are less than 60 years of age. They have opted for the new tax regime and are residents of India. However, the net taxable income differs from one another. In case 1, the net taxable income is 11 lakh 50. In case 2, the net taxable income is 12 lakhs. Under case 3, it's 12 lakh 24,000. And in the fourth case, it's 16,85,000. First of all, we'll try and calculate the basic tax as per the new tax regime. Solution. So here's the snapshot of the new tax slab as per the new tax regime, along with the rates of tax. Say for example, if my total income as per case 1 is 11,50,000. On the first 4 lakhs, in the table aside, we can see there will be 0% tax up to 4 lakhs. So, on the first 4 lakhs of the total income, 0% tax will be charged. Next slab is 4 lakh to 8 lakh. On the next 4 lakhs, tax will be charged at the rate 5%. So, from income in between 4 lakhs to 8 lakhs, the tax rate would be 5%. Since the total income is less than 12 lakhs, that is 11,50,000, on the remaining 3,50,000, 10% would be chargeable. So this is how we calculate the basic tax. Now let's move to the individual cases. Case 1. The individual is less than 60 years of age. Total income is 11,50,000. Has opted for the new regime and is a resident. So, on the total income of 11,50,000, on the first 4 lakhs, 0% tax. On the next 4 lakhs, 5%. And since the total income is less than 12 lakhs, on the remaining 3,50,000, 10% of tax would be applicable. So, basic income tax on 11,50,000 would be 55,000. Now, the first thing we need to check is whether the individual is a resident individual or not. In case 1, the individual is a resident individual. Thus, the rebate under section 87A would be available to such individual in this case. Also, the second thing we need to check is whether the total income is up to rupees 12 lakhs or not. Here, the total income is 11,50,000, which is less than 12 lakhs. Thus, the rebate under section 87A would be available. Since both these conditions are now satisfied, thus 87A rebate is granted to the individual. The rebate would be 100% of the tax calculated or 60,000, whichever is lower. So 100% of tax calculated is rupees 55,000 or 60,000, whichever is lower. In this case, rebate would be 55,000. So, income tax after rebate is nil, and thus no tax will be payable in this case. Now, second case. In second case, the individual is less than 60 years, the income is 12 lakhs, and he is still a resident. So, let's plot the entire taxable income, which is 12 lakhs. Now, let's check the income tax slab. Up to rupees 4 lakhs, 0%. So, on the first 4 lakhs, it would be 0%. From 4 to 8 lakhs, it would be 5%, which is okay. Since the total income is 12 lakhs, thus, on the remaining 4 lakhs as well, at the rate 10%. Income tax on 12 lakhs would be 60,000. Now, for rebate, we need to check if the individual is a resident. Yes, he is. Is the income up to rupees 12 lakhs? Yes, it is. So, the individual would be granted rebate under section 87A, which would be lower of 100% of tax calculated or 60,000. In this case, 60,000. So the tax payable after rebate is nil, and thus no tax will be payable in this case also. Moving ahead with the third case. In case 3, the individual is less than 60 years of age. Total income is 12,24,000, opted for new tax regime, and is a resident. So we plot the entire total income. On the first 4 lakhs, 0%. From 4 to 8 lakhs, 5%. Then from 8 to 12 lakhs, 10%. And since the total income is less than 16 lakhs, so on the remaining 24,000, at the rate 15%. So basic income tax is 63,600. Now we check the rebate. Is the assessee a resident individual? Yes, it is. Is the total income less than rupees 12 lakhs? No. So, since one of the conditions is not satisfied here, hence rebate under section 87A will not be available. So, rebate under section 87A is nil. So, income tax after rebate is 63,600. Now, if you see something, you'll find something different here. Just because the assessee earned an additional 24,000, he's being asked to pay 63,600. Just for earning 24,000, he's being asked to pay 63,600 to the government as taxes. To remove this injustice, government introduced a relief provision to this section. Now, what's that relief? Say the assessee earns 12,24,000 during a financial year and is not allowed rebate under section 87A because of the maximum limit of 12 lakhs of the total income. In such a case, the assessee will be required to pay only to the extent of the additional income earned. In this case, the additional income earned is rupees 24,000. Thus, he'll be required to pay only up to the additional income earned and not the entire 63,600. This is the relief that has been provided by this section. Now let's quickly look at the steps to calculate the relief. Step 1. Check if the total income minus 12 lakhs is less than 63,600. That is the tax calculated above. So the first condition is the total income minus 12 lakh less than the tax calculated above? Step 2, if the answer to the above question is yes, in that case, relief is equal to tax calculated minus total income minus 12 lakhs. If not, then relief would be 0. In this case, since 12 lakh 24,000 minus 12 lakhs is 24,000, which is less than 63,600 here, the answer to the first step is yes. Since the answer to the first step is yes, we move to the second step. If yes, relief is equal to tax calculated minus the total income minus 12 lakhs. So 63,600 minus 12 lakh 24,000 minus 12 lakhs. So which comes to 63,600 minus 24,000. And the answer is 39,600. So relief as per 87A proviso would be 39,600 and the tax payable would be 24,000. Please note, on this tax, education cess will also be payable. Moving on to the fourth case. Here the income of the assessee is 16,85,000, less than 60 years of age, is also a resident individual. Let's quickly plot the total income. 16,85,000. On the first 4 lakhs, 0%. 4 to 8 lakhs, 5%. 8 to 12 lakhs, 10%. 12 to 16 lakhs, 15%. And since the total income is less than 20 lakhs, on the remaining 85,000, at the rate 20%. So basic income tax comes to 1,37,000. We need to check for rebate again. Since the total income is greater than 12, no rebate will be granted. Income tax after rebate 1,37,000. Now we check for the relief. Step 1, total income minus 12 lakh. Is it less than 1,37,000? No. In that case, we move to step 2. In case answer to step 1 is no, relief would be 0. Thus, relief as per 87A proviso would be nil. So, tax payable in case of individual D would be 1,37,000. Again, please note, education cess will be added to this tax. Here are some examples for your further practice. Note, the new regime is available to both the resident as well as the non-resident. But rebate under section 87A is available only to resident individuals. Now you can practice these. The solution is also here under. So this is how we calculate taxes under the new tax regime. Now let's quickly move forward to the tax rates offered by the old tax regime. The old tax regime would be available where in case the assessee specifically opts for it. And this would be used to calculate the advance tax or the TDS on salaries for the financial year 2025-26. If the assessee opts for the old tax regime, then in such a case, the rates in force for the calculation of TDS on salary and the advance tax during the financial year 25-26 would be as under. In case it's a resident individual with less than 60 years of age or a non-resident individual, AOP or BOI, or an artificial juridical person, then in such a case, this would be the income tax slab. Up to rupees 2,50,000, 0%, 2,50,000 to 5 lakh, 5%, 5 lakh to 10 lakh, 12,500 plus 20% on the remaining. Above 10 lakhs, 1,12,500 plus 30%. In case the person is a resident individual, we this 3 lakhs 0%, 3 lakhs to 5 lakhs 5%, 5 lakhs to 10 lakhs 10,000 plus 20%, above 10, 1,10,000 plus 30%. In case the resident individual is more than 80 years, the income tax slab would be as such: 5 lakh 0%, 5 lakh to 10 lakh 20%, and above 10 lakhs 1 lakh plus 30%. The rebate in this case would be up to rupees 12,500. That too only if the total income of the assessee is 5 lakhs or less. Same thing, the rebate under section 87A would be available only to the resident individuals. Moving on, the rates in force for calculation of advance tax for the rest of the assessees are this. For partnership firms, on the entire income, 30%. This means there's no exemption limit for partnership firms. In case of cooperative society, up to rupees 10,000, 10%. 10,000 to 20,000, 1,000 plus 20%. Above 20,000, 10,000 plus 30%. For domestic companies having turnover or gross assets less than 400 crores in the previous financial year, that is 23-24, the tax rate would be 25%. Other than the above, 30%. For companies other than the domestic companies, in case the income contains royalties and technical fees with such parameters, tax would be calculated at the rate 50%. On the balance income, at the rate 35%. However, remember, these tax rates would be applicable from the financial year 2025-26. This means the returns that are due for filing on the 31st of July 2025 under Section 139 subsection 1, these tax rates would not be applicable. With this, we end our video here. Some of the remaining amendments will be continued in the next part. Thank you.